Ordinary shares, one common mechanism used by the company to raise huge capital. Because one, there is no fixed redemption date. It's not for a specific period of time. Once a share is being given of a particular company, it is eternal. Unless the person who has purchased it, he sells it in the secondary market, but as long as he wants to hold it, he can very well hold on to it. So it's a kind of ownership in the company. For whatever the number of shares that are purchased, that as a proportion of the total number of shares that are there in the company is a measure of ownership stake. So and there is no fixed payment, the dividends, because they are the owners, they are getting whatever is left after making all the obligations. They are not promised anything like interest. In a debt capital, in a loan, they are very much, the lenders are very much promised the interest at the beginning of taking up the loan itself. Whereas in case of ordinary shares, they are treated as owners, and they are not promised any kind of payments in the form of dividends. Right? So they are more and more associated with a few rights. What are those rights? Whatever are the profits the company is making, after making payments to probably all the cost of goods, making payments towards interest, making payments towards selling, administrative, employee, all kinds of expenses, whatever are they left with, they have the right on that profits. So they may receive some portion of the profits in the form of dividend, or they may plow back the profits into the business in the form of retained earnings. But that profit typically belongs to these ordinary shareholders only. Now, on the other side, let's say the company is winding up, right? The company is winding up. Now, whatever the assets that are left with the company after settlement towards the lenders, after payment towards the lenders, whatever are the assets of the company that are left, they are going to have a ownership of those assets. And at the same time, any time for any crucial decisions of the company, they do vote. They do have the power to vote in the annual general meetings or any kind of decisions the company is typically getting into. And on a regular basis, whenever the company is publishing, they will receive the financial statements, the annual financial statements, quarterly statements. They are receiving on a regular basis, and they can even go to the annual general meetings and speak up. So there are some specialized rights that are associated with the ordinary shareholders, because those are treated on the same lines as the owners of the firm. Now, why does a company typically issue these ordinary shares? From a company's perspective, if I look at, they are they are least in priority in terms of when it comes to settlement, because they will in case the company is getting winded up, they are the last in priority. They are going to get whatever is left off after paying to the debt investors, after paying it to the creditors, after paying to employees, whatever is being left, they are going to have the claim only in the last priority, which means a company, if it is having more in this form, even when it goes bankrupt, it has nothing much to lose. So that is one thing the companies typically look out for. The ordinary shares go least in priority when it goes to settlement. So the companies prefer, there is no mandatory payment, right? Probably if they are going for a debt issue, if every year the interest has to be paid mandatorily. Whereas in this case, the dividend payment is purely in case the company generates a profit, is the board of directors and the management, the dividend payment can be completely at the discretion of them, and it's nowhere a legal obligation. That's one reason the typical company management would prefer going for ordinary shares. And one main thing which we see is even those people who have invested, they become the owners or the shareholders, so they can't start demanding the interest or any kind of payments. And first of all, no regular payments in the form of interest and all. So probably everything can be held as a part of the capital gain, because there is no dividend payment that is happening. The running yield, the cash outflow that is happening in the current year is much lower. Probably the capital gain is occurring faster, but the running yield is much low. So because of all these reasons, the issuer really feels going ahead with an ordinary share issue is much more effective. And on the other side, even the investors prefer purchasing the shares. Forget about only the issuers. Look at the investors' dimension as such. First of all, the company in which they are investing, they feel that the company profits will go up with inflation. Why? Because as the prices are increasing, the company's sales also is going to go up. And if the sales is because they will also price it higher, sales is going up, profits are going up, and the dividends are paid out of the profit. So they expect that the dividend growth rate also will be higher. Dividend growth also will be higher, which means the capital gain that they are going to get also is going to be higher, which is a clear indication that the investment in the shares is being treated by the investors as a very good protection against inflation. Right? Against inflation, the prices are going to rise, so it is treated as a good protection against inflation. So with time, the dividend is expected to grow. The capital, the capital gain and the capital market capital or capital of that particular company is expected to grow. So because of this reason, investors really prefer dividend to be or investment in the equity to be a very good protection against the inflation. And at the same time, the dividends and the capital gains, they are even volatile as such. In some cases, they fluctuate quite heavily. In some cases, they fluctuate in a very limited range. And because of this kind of volatility that is associated with both of these, it is even expected by the overall community that the expected return, volatility is a measure of risk. Because the risk is higher, the expected return should be even more higher. So even from that perspective, they would be of the feeling on an average we are going to get slightly higher return compared to investing in a bond or some kind of bank deposits. And today the stock markets have evolved evolved quite efficiently, which means majority of the shares now become highly marketable also. Of course, today there is a lot of difference between the shares of a very large company versus shares of a very small company. There is a huge variation in the levels of marketability or even in the levels of liquidity. Liquidity is a process wherein the buying and selling can happen very frequently. Even the large volumes can be sold and bought without affecting the price. Right? I mean, availability of good number of securities for buying and selling without impacting the price. Whereas even the marketability is talking about how much people are aware of the shares of this particular company, how comfortably I can sell the shares of this company to others. So, especially for large companies, this is nowhere a problem. But even for small companies, some of them which are listed on the exchange, they are quite comfortable to be marketed. And at the same time, because people invest in different shares of the companies, they are getting exposure to a wide variety of industries. Otherwise, they don't have a specialization in any of those industries, so they may not be able to invest in those companies at all. But because of this concept of ordinary shares, they are able to participate in some form in the business growth of different kinds of industries. In some cases, they are getting the exposure to those kind of industries which they don't even have any level of expertise in. So that's the kind of a difference with respect to the investment strategy that can be brought out because of the ordinary shares. All right.